Yo, I ain't here for the money, I ain't here for the fame. Though it might be nice to own a jet plane.
Back to the channel. Today, we'll be taking a closer look at some of the companies that have the potential to move the market in the near future. Specifically, we'll be previewing earnings for companies like Verizon and Raytheon Technologies, as well as discussing how their results may affect their stock prices and the overall market. We'll also be discussing any other relevant market news and analyzing their potential impact on your investments. Before we dive right in, let's recap what happened last trading session, January 20th, 2023. The US stock market clawed back some of this week's losses as a tech rally buoyed risk sentiment, and comments by Federal Reserve officials dialed back fears of overly aggressive policy moves. The S&P 500 index rose for the first time in 4 days, with all 11 sectors gaining. The Nasdaq 100 also saw a big boost, pushing it into the green for the period. First up, we're going to take a closer look at Verizon Communications, or VZ stock, as they prepare to report their fourth quarter earnings on Tuesday before the market opens. Because of stiff competition from T-Mobile, I am staying neutral. I don't expect a big move. I am long on Verizon because of its attractive dividends. If they report worse than expected earnings, I will be adding more shares to my portfolio. Let's dive right into Verizon analysis. Verizon Communications, VZ, is a telecommunications giant that has consistently underperformed the S&P 500 but often attracts income-oriented investors thanks to its dividend. However, if 5G wireless services reignite earnings and revenue growth, Verizon stock might have much greater appeal. The company is set to report its fourth quarter earnings on Tuesday before the bell, and investors will be paying close attention to see if the company's recent efforts to build out its 5G network and cut costs have paid off. Verizon has gained more than 6% so far in 2023, but the stock retreated 24% in 2022, while the S&P 500 fell more than 19%. In early January, Verizon CEO Hans Vestberg said the company expects positive consumer postpaid phone additions in Q4, rebounding from a loss of 89,000 in the September quarter. He also announced that capital spending in 2024 will fall by about 23% to around $17 billion, as the company's build-out of its 5G wireless network will be largely done by then. The mobile phone giant faces a fierce marketing battle amid the deployment of 5G networks, and with wireless service providers, including AT&T and T-Mobile, responding with new promotions, Verizon may be in a tough position. Rather than chase subscriber market share, Verizon has focused on average monthly subscriber revenue. Telecom stocks have been viewed as a defensive play amid worries that a recession may hit the US economy. As a Dow component, Verizon stock pays a 4.8% dividend. However, one overhang on VZ stock is the mid-band radio spectrum it bought for 5G wireless services. Verizon spent $53 billion in a government auction, including incentive payments to satellite operators and clearing costs. The purchase of mid-band spectrum for 5G services will delay a VZ stock buyback. In a bright spot, Verizon in November finally closed the $6.25 billion acquisition of TracFone, which sells prepaid wireless services. However, the company will face increased competition as T-Mobile's acquisition of Sprint created a stronger rival, and AT&T's merger of its Warner Media business with Discovery is expected to have more money to invest in 5G wireless technology and fiber optic services. Now that Verizon owns sufficient 5G mid-band spectrum, its network build-out will be key. The company aims to reach 175 million people by the end of 2022 with mid-band spectrum-based 5G services that provide faster data speeds. Additionally, Verizon plans to use the 5G mid-band spectrum to deliver fixed broadband services to homes, which will be a significant challenge as cable TV companies currently dominate in residential broadband. The company said its fixed broadband service will reach 30 million homes by the end of 2023. Verizon expects 5G business services to gain momentum in 2022 and is investing in mobile edge compute sites that provide private 5G business services. The company has also partnered with Walt Disney, Hulu, and ESPN Plus in video streaming services, as well as with Apple Music services and various sports leagues. In conclusion, while the competition in the wireless industry is fierce, Verizon has a solid plan in place to build out its 5G network and cut costs. The company's fourth quarter earnings report will be an important indicator of the success of these efforts. However, because of the stiff competition, I remain neutral on the stock in the short term. But for long-term investors, Verizon's dividends make it a good option to consider for a hold. Next on our list is Raytheon Technologies, which is also set to report their earnings on Tuesday before the bell. This company is a major player in the aerospace and defense industry, and investors will be looking for updates on their performance and any potential growth opportunities. A lot of the air defense system provided to Ukraine came from Raytheon. Raytheon Technologies, an aerospace and defense company, closed the most recent trading day at $94.36, moving plus 0.13% from the previous session. This performance lagged the S&P 500, which gained 1.89%, and the tech-heavy Nasdaq, which gained 10%. In the past month, shares of Raytheon Technologies have lost 4.33%, while the aerospace sector lost 2.07% and the S&P 500 gained 2.3%. As the company approaches its next earnings release on January 24, 2023, analysts are expecting Raytheon Technologies to post earnings of $1.24 per share, which would mark year-over-year growth of 14.81%. In addition, the consensus estimate for quarterly revenue is $18.2 billion, representing a 6.76% increase from the previous year. Recent changes to analyst estimates for Raytheon Technologies have been noted by investors, as these revisions often reflect the evolving nature of short-term business trends. Positive estimate revisions have been seen as a good sign for the company's business outlook. Research indicates that these estimate revisions are directly correlated with near-term share price momentum. The Zacks rank system, which ranges from number 1, strong buy, to number 5, strong sell, has a track record of success, with number 1 stocks delivering an average annual return of plus 25% since 1988. However, at this time, Raytheon Technologies holds a Zacks rank of number 4, sell. In terms of valuation metrics, Raytheon Technologies currently has a forward P/E ratio of 18.24, which is lower than the industry average of 20.32. Additionally, the company has a PEG ratio of 1.93, which is a metric used similarly to the P/E ratio, but also takes into account the stock's expected earnings growth rate. RTX's industry had an average PEG ratio of 2.78 as of the close of the market on the day the article was written. This suggests that Raytheon Technologies may be undervalued compared to its peers in the aerospace, defense equipment industry. It is important to note that, as of the time of the article, Raytheon Technologies was holding a Zacks rank of number 4, sell, which is one of the lowest rank, and according to Zacks system, it indicates that it might be a good idea to sell the stock. And also, the aerospace, defense equipment industry was ranked 176 out of 250 plus industries by Zacks, placing it in the bottom 31% of all industries, suggesting that the industry as a whole may be underperforming. However, it's also worth mentioning that the Zacks rank is just one tool for evaluating a stock, and it's important to also consider other factors such as the company's financials, industry trends, and macroeconomic conditions. Additionally, it's important to keep in mind that past performance does not guarantee future results. In summary, Raytheon Technologies is an aerospace and defense company that has underperformed the S&P 500 in its industry in the past month. The company is expected to report earnings of $1.24 per share and revenue of $18.2 billion in its next earnings report, which is due on January 24, 2023. However, the company is holding a Zacks rank of number 4, sell, and the aerospace, defense equipment industry is ranked in the bottom 31% of all industries by Zacks. Additionally, the company may be undervalued compared to its peers, with a PEG ratio of 1.93. Investors should carefully consider all of these factors before making any investment decisions. Even though they rank as sell, I like them for long-term hold. RTX will need to come down to 70s before I add more to my portfolio. As always, it's important to conduct your own research and consult with a financial advisor before making any investment decisions. Thank you for listening, and stay tuned for more updates on the market and its key players.